Hi everyone, welcome to our Module 7 discussion, and we will go over chapters 18 and 20 in this. So first we'll start with chapter 18, the long-term financial planning. As I was mentioning earlier, this is a very handy tool to know, and when you prepare your budgets, you will make use of them. So we'll go over what is financial planning. We'll go over the financial models. We'll do an example, the executive cheese company example, executive fruit company example. We'll talk about some areas of caution that we need to have or look at. And we'll talk about the growth rate and the need for external financing. So first of all, the financial planning process. Whenever you're running your business or practice or whatever you're doing, you need to have a financial plan in place. And what we do in financial planning is we analyze all the investment. There are two kinds of decisions we make: investment decisions and financing decisions. Investment is what assets to invest in, and financing, how to finance those assets. How are we going to raise money for those assets? So when we analyze in the financial planning process, analyzing the investment and financing choices, that is very important for our business. So we look at that. We project the future consequences of our current decisions. That is very important. So all the uncertainties we take care of, and what will be our course of action, we decide on that too. Decide what alternatives to undertake. Whatever scenario we are working on, and whether it is optimistic, pessimistic, whether it is average or normal scenarios, we look at those and all possible alternatives we look at and our course of action there. And then we measure subsequent performance against the goals that we set in the financial plan. And then we look at deviations and we look at the causes and then continue the process. So this is the whole idea here. So how long should be the planning horizon? This is the first thing. The short-term plans, we know that it is about within a year, the next month to month we go, and in the next 12 months, what happens? But long-term plans, we are talking about 5 years on an average. Some companies go 10 years also, but 5 years is on average. So 3-year plan, 5-year plan, we have to have all those in place. And as I said, the different possible scenarios, different departments and companies, they're asked to submit optimistic or best case scenario, then the expected case scenario when there is a normal growth. Optimistic case is, when you are going very fast growth and you're doing very well. And pessimistic is, when the growth is very limited and there is retrenchment here and bad possibilities, bad economy, all those kinds of things. So we look at all these kinds of scenarios, okay? And very important over here is to remember that our financial plans, they should help us ensure that all our financial strategies are consistent with our capital budgets. It's very important to be in line. And so these plans, they highlight the financial decisions necessary to support our firm's production and investment goals, all the goals. And they should be consistent. Our strategy should be consistent with the budget, everything, they should be in line, they should be in sync. It's very important to have that. Again, there are some terms we have to know. Contingency planning is very important. What we do this is a common practice in corporations. We worry about both likely events and unlikely events. What happens if the system fails? What happens if that happens? Do we have a backup? And we formulate responses to them. So contingency planning is very important in our business. What if this fails? What if this strategy fails? What if that strategy fails? We got to have a backup plan, right? So that is very important. We have to consider different options, exploit our existing strengths. What are the current options, what we have? And of course, sometimes we might also think of, picking up negative NPV projects also, if the strategic long-term vision is very promising. So all the options we have to consider. So you will find that in Midwest, we made a lot of investment in fiber optics and all the network lines for a long time. That in the beginning, it was a negative NPV project. They were just investing. But the hope was that in future, this is going to be very useful. And that's what we are reaping the benefits of now. And consistency is very important in our financial plans because they help us ensure that our goals are mutually consistent. Everybody has the same focus. All the areas within the operation, they have the similar focus so that our goals are aligned with the total corporate goals. That is very important. There are different ways of ensuring this. Six Sigma, balanced scorecards. These are some ways you must have heard of in companies, and some of your companies might be following them too. And it is so important to have everybody's goals consistent with the overall business, the overall goal of the corporation or the business. This is very important. And the larger the corporation, the larger the business, the more the chances that the goals are fragmented. People don't have the same goals. In fact, I was just doing a balanced scorecard session in Belgium for the European and Middle Eastern section of Starwood hotels. And all the corporate heads were there. You had all the, the vice presidents and managers, and the lowest level was, there was a senior manager over there. So I was trying to implement or teaching them balanced scorecards, and I broke them into groups. And I said, okay, let's talk about our goals. And the idea was to see whether different ranks and different people within the organization, they have the same goals or similar focus or not. And you'll be surprised that people did not know what either the superiors did not know the subordinate goals were inconsistent, or subordinates did not know whether superior goals, this is the corporate goals is what they're vying for. There was a lot of fragmentation there. And that is a major cause of problem. So consistency, forcing consistency through our financial plans is very important. So our model here, the financial planning models, when we're talking about, what does it consist of? It consists of inputs. That means your data as of now, the past data, everything is there. Current financial statements, these are forecasts of the key variables. What is the sales? What are the interest rates we are looking for? What are the sales levels we are looking for? These are the inputs to the model. And then you put the planning model. You specified as equations for key relationships. Not a listing of goals. Your planning model is, it is a tie-up through equations of all your key relationships of the variables. And then you have your output, that will give us the projected financial statement or pro forma financial statements, financial ratios, sources and uses of funds, all those kinds of things. So they'll give us our outputs. So we have some assumptions, we have some inputs, and then we have the model, and then we get the output. And we'll go through this process. So projected and forecasted financial statements are called your pro forma statements. Then we have another term that you should be aware of is a percentage of sales model. This is a very common approach to creating our budgets, modeling for our budget. We use the revenue, sales as the basis, and we base all our costs on the sales. So there is a planning model in which sales forecasts are the driving variable, and most of the other variables, such as your variable costs and other things, they are proportional to the sales. And we tie the whole model to the revenue changes and some assumptions like that. Now, whenever we create these models and we create pro forma statements, you will also come across a term called, you will need to know what is a balancing item. This is also called a plug in your budget. So what are these balancing items? You have to identify those in your budget and then work on them. These are variables that adjust to maintain the consistency of a financial plan. And we'll go through this. These are also called plugs. So when you are trying to create a budget, you will come across this term and you will know, well, what is the plug I have to use here to balance the budget. And again, it depends upon the policy of the company. It depends upon a lot of variables here. So some models over here, net income, for example, we said there are equations, right? So net income, we say that is, as soon as we make net income, so we work, we get revenues, we deduct costs, and then we get net income after taxes. Now, from this net income, a part of the net income we plow back into the business for growth as retained earnings. Now, more faster growing corporations, they will retain much of their earnings, because they want to grow. And part of the net income, whatever is left, we pay out to the shareholders as dividend, or the owners as dividends. Now, this term is going to become very important now, at least now, when we are seeing the difference between dividend and corporate tax rates, the capital gains tax rates. The capital gains tax, there is a talk of increasing that, doubling it. And so you will see that more and more dividends will come. If the dividends are not taxed at that rate, you will see more and more dividends will start coming from the corporations. So this is a very interesting thing. You have from the net income, plow back some money as retained earnings, and the rest you pay out as dividends. And now, if you want to grow, for growth, to sustain that growth, you will need to have new assets. If you want to say, my sales has to increase by 10% or 20%, how? You have to have some strategy for it, right? And for that, you need resources. You will need assets, whether current, in terms of working capital, net working capital, or in terms of long-term assets. But you will need new assets. So you'll need to invest in those. So how will you invest in those? Either, obviously, from the money that you retain in your business, that is the internal. That is the first thing. Remember the pecking order theory, where you finance everything through your internal funds first. And then after that, whatever else is needed, we require external financing. Now, external financing, again, you can have through equity or debt. So new equity, new debt. Depends upon the policy of your business, of the management. So when these are some of the models over here, you see some examples of models. And you enter the data provided for each variable, and whatever variable you don't have the data, that becomes the plug. So that is called the balancing item. And how do you get the data? Of course, it is determined by policy or rules established by the company. And then you create these equations and, these, and then create what if scenarios on a spreadsheet. Okay, what if it is a positive, optimistic scenario, pessimistic scenario, sales increase by 20%, that's an optimistic scenario. Sales go down by 20%, that's a pessimistic scenario. The sales go up by 3% or so, or sales stay the same, that's the normal average scenario. So you can, what if scenarios you create using spreadsheets, and simulation models that you might have. So with that background, we are ready to look at some examples, how to do this. And we start with percentage of sales model. So we start with the executive cheese company. And in your book, they have given the illustration. So I'm going to use the same illustration here to explain it to you. Very handy. So the current income statement and balance sheet for executive cheese is there for us. That is the input of, obviously. So my sales are $1,200. My costs for this company, all the costs taken, is $1,000. And my net income is $200. Okay. And the balance sheet, my current assets, my total assets, not current, but currently my total assets as of now are $2,000. And this is financed $800 by debt and $1,200 by equity. So total assets equal total debt plus equity. And this is my current situation. So the projection is for 10% growth for next year. The executives, they get together and say, okay, how are we going to grow? So 10% they're projecting a growth, and they are assuming that this will be a percentage of sales model they'll create. So all your costs are moving in fixed proportion of the sales. So 10% growth in sales, so 10% growth in costs also they are projecting. But again, you'll have to break these into fixed and variable cost, and we see this. But this is just a start we are seeing. So my cost will also move 10% more. So here we are, $1,200 sales, cost $1,000, net income $200. So in my projection, it's 10% growth. My sales grows by 10% of $1,200. That's $120. So $1,320 my sales. Again, 10% from $1,000 increase. So that's 1,100. This is my cost. So my net income also increases to $220 from $200. So 10% growth here also. Now, to sustain this higher level of output, the company plans to increase plant and equipment by 10%. 10% of $2,000 is $200. So my assets will increase to $2,200. And the rule is, okay, how are we going to finance these assets, this growth of $200 in my assets, the increase in the assets? Through debt and equity. But we want to maintain the same debt to equity ratio. My debt to equity ratio, maintain the fixed debt to equity ratio. So my debt will also grow 10%, my equity will also grow 10%. So there we go here. We have our debt of $800 and equity of $1,200. So 880 and 1,320, 10% growth in each. So that's how I finance this growth in my assets. All right. Now, here they are saying that, okay, let's keep dividend as the plug. In this model, you will see the plug is the dividend. That means from $220, $100 has been paid out in dividends. $100 in pay, so $180 left. $80, $180 you are supposed to raise. We'll go over this in detail. So 10% growth here, 10% growth here, my total 10% growth here balances out, and I have a total of $2,200 over here. Let's go into details of this. So my plug over here is dividend is the adjusted amount that I'm doing. Dividend, notice I have got, this is the last thing that we will do. We know that, okay, my first priority is keeping my growth in my debt and equity, 10%, 10%. You know, so if I'm keeping my growth in debt and equity, my equity has grown, you know, from $1,200 to $1,320, right? Now, the net income over here is $220. Out of this, I raise my dividend, I pay dividend, part of it I retain back in the business for growth. That will be included as the equity, retained earnings will be part of my equity, right? So that's how it works. We'll illustrate more over here. I'm just using one variable over here as a plug, but you can keep, you know, let's explain this further, okay? So here is how we look at plugs in more detail, okay? So some more examples. My original debt was $800, remember? My equity was $1,200. Now, in the first case, where I'll explain through panel A, I use just debt as a plug. So these guys are using debt as your balancing item, and they keep dividend fixed. So you have to decide your policy. What is the policy first? My policy is that my pro forma balance sheet will have fixed dividends of $180. This is the first policy decision they decided. Remember, dividend is a sticky policy. So if you have been paying dividends to your shareholders, you know, you can't change much. So they're saying that, okay, we'll stick with our old pattern of whatever we had. So we'll pay $180 dividend fixed. Okay. And we will use debt as the plug, as the balancing item, only debt. Okay. So now what happens? What do they need? They need to increase $200 plant and equipment. They need to increase plant and equipment by $200. So the additional money that they want is $200. So in this case, how much did I make in this company? My net income was how much? $220. $220 was my net income, out of which, you know, we retained $40. The retained earning was $40. So that means my new equity, look, 220 minus 180 dividends is $40, right? So I retain back $40. That means my equity will increase, the old equity plus $40 will be my new equity, right? And so my equity is now $1,200 plus $40, $1,240. So this is per policy I've done this. So then what is there is the balancing item, the debt. So my debt over here will be what? My debt will be you can go so many different ways. Easiest way that I find is $200 you need, right? Minus $40 you plow back your own money, you know? So the balance of $160 is the debt that you need. That will be your balancing item. So this $800 was the old debt. Now you issue out more debt, you borrow more money, and it's $160. You're balancing the whole thing, $2,200, $2,200. So this is using debt as the plug or debt as the balancing item and keeping my dividend fixed, dividend policy fixed, $180. Both cases we are keeping dividend fixed, but here in the second scenario, we use both debt and equity to raise money. Okay. So, but there is a policy over here that we don't want to borrow more than 100. My new debt will be limited to $100. Well, I don't want to raise my debt equity ratio that much. You will come across this in your Londonderry case also, this kind of a situation. So now, in this case, in the second scenario, we need $200 for more assets, plant and equipment to support the growth. And the policy is that my dividends will stay fixed at $180 per policy. So once again, as in panel A, my equity will increase by $40 and $180 out of the $220 will pay out to the shareholders as dividends. Then my external capital that I need is, $160, right? Like in this case. But in this case, we have to limit our debt to $100 per policy because we don't want to raise the debt equity ratio or debt to asset ratio or leverage ratio. So the balance, $60, will be financed by equity. So you can look at it either way. You can say, okay, $200 is the additional capital that I need, my capital growth or asset growth. Out of that, $40 will be financed as retained earnings, my internal money, and $100 will be financed through debt per policy. So the balance 60 that is left over, that is my balancing item, and that is through debt. So this is using both debt and equity over here. But so my debt has gone up from $800 to $900. So this is how we make use of plugs in our budget. As you will notice, the assumptions are very important here. Your policy is very important. So you should write those up front. Even there, you go to such fine tuning of assumption that when you talk of sales and revenue growth, how much cash, how much credit, that also, if you fine tune to that level, then it will be much more realistic. Your credit policy will be decided by that. We'll talk about that. So let's talk of another example, Executive Fruit Company. Now we are going in more details, more specific. The first one was very rough and very, very, like you just talked of debt, equity, we just talked of, sales and costs. Now here we are going to some more details here of costs and all those things. Even debt, we are talking about everything. Net working capital also we'll talk slowly. So another example here. The financial statement is given. Again, we are using percentage of sales. And revenue over here for this company is $2,000. Cost of sales or cost of goods sold is $1,800, which is 90%, 1,800 out of 2,000, 90% of sales. This is the situation in this company just now. EBIT is 200, EBIT is again difference between revenue and COGS, And this also you will take as a percentage of revenue if you want to take. This is 10% of your revenue. Then my interest payments are $40, and based on the trend, it is 10% of the debt at the start of the year, at the beginning of the year. That means last year's balance sheet. Okay, 10% of that. Start of the year is what you begin with, 1st of January. And that is probably the figure from 31st December of last year balance sheet. So my Earnings before tax, or EBT, is your earnings before interest and tax, or EBIT, minus your interest is $160. Taxes are 40%. At 40%, they have been taxed. So it's 40% of your earnings before tax is $160, EBIT minus interest. So these are important because when you set up your equations in your spreadsheet, you will use these relationships. So that is $64. So your net income is 60% of this, so that is $96, EBIT minus interest minus taxes. Now, another policy issue is that the payout ratio in this company is two-thirds of net income. So two-thirds of $96 is $64. That is the dividend that is paid. So they pay themselves heavily, the shareholders over here. And the retained earnings is the difference between 96 and 64, net income minus dividend is $32. So this is their situation here. And you saw the nature of the relationship between the costs and the revenues and those numbers. For balance sheet, notice over here that it consists of your current assets and fixed assets. Current asset, your net working capital, is $200, and your fixed assets is $800. So your total assets is $1,000. Now, this is a policy decision, and you strive for that. In this company, the net working capital levels they keep at 10% of sales. It depends upon the industry that you are in. Where you're working, the trend is different for every industry. Here it is 10% of sales. Sometimes some industries for example, like restaurant industry, you will see that it is hardly, 2%, 1%, like that. The net working capital is very marginal. So again, it depends upon your industry. Fixed assets is 40% of sales. So where the investments are going. And my total as $1,000. How do you finance these? 40-60 is the ratio of debt to equity. Long-term debt to shareholders' equity is 40-60. So that is the proportion that is based on your industry trends or your, whatever it is. So that's what it is. Total liabilities is 1,000, and the assets equal liabilities plus owner's equity is $1,000. So this is the situation here. Now, suppose you are now asked to prepare a pro forma financial statement for the next year. And there are some assumptions that you have to go by. And first is that your sales and operating costs are expected to be up by 10% over the 2014 results. So both your sales and costs will be increased by 10%. Your interest rate will remain at the current level of 2014. So your interest over here is 10% of debt. So at the start of the year, so the ending balance. So for 2015, it will be 10% of the debt for, the ending of 2014. Okay, that's what you start with. And the firm will stick to its traditional dividend policy of paying out two-thirds of earnings. So that they are going to stay. They remember dividend policies are sticky. So they stay with the same two-thirds. And of course, this company will need 10% more fixed assets. So it will finance its growth of 10% of sales through 10% increase in fixed assets and net working capital next year. That will support their higher sales volume. So now we are supposed to prepare a pro forma statement. And the more sophisticated approach is a two-stage approach, where you do the first stage pro forma calculations for this company and show what would happen if the size of the firm increases along with the projected sales. But at this preliminary stage, in the first stage, we do not find out what is the specific mix of debt and equity and all those kinds. We just determine the required external financing needs. That is the first step, in the process. First stage pro forma. So Here is the example of the first stage pro forma. This is how we'll go. Okay, we know that our costs and revenues increased by 10% of last year. So instead of 2,000, it become 2,200. And instead of 1,800, it will become 1,980, 10% higher, 180 more. So then you will deduct the COGS from the revenue and you will get the EBIT, which will be 10% more. Instead of 200, it will be 220. Everything is increasing 10% here. So your interest will stay $40. How will it stay $40? It will be $40 because it is 10% of the beginning of the year debt, which is last year's balance sheet, which was 400. So your debt was, if you recall, this is 400. So your interest will stay $40, right? So your EBIT will be the difference between the two, $180. Your tax rate is the same 40%, which is 40% of 180 is $72. And then the net income is the difference between these two, 108. Your dividends will be 2/3 of net income, which is the policy here, 2/3 payout. So that is $108 net income minus 2/3, which is $72 is your dividends. You deduct that. So how much are you retaining back for your internal growth? This is $36 you're retaining back. So this is the pro forma income statement that we create. Now we use this and move on to the balance sheet. This information will be needed, when we talk of how we finance the assets, as additional assets. So now we come to how do we finance our increase in assets? First of all, my assets. We know that net working capital increased by 10%, fixed asset increased by 10%. So 10% of $800 is $80, 10% of 200 is $20, so 220 will be a net working. So total, we add up, my total assets will be $1,100 instead of $1,000. So it's, we'd like to talk in simple numbers, you could be in millions or whatever, but you can just write on top, it is millions. So this is what it is. My total asset is 1,100, it is 10% higher. How do I finance this additional assets? How do I finance that? Okay, so the policies over here. First is that I'm holding my debt fixed at $400, temporarily held fixed at $400. And I just plow back the entire financing will be equity over here. So I'm taking my $36 retained earnings, I'm putting it in shareholder retained earnings over here. So my shareholders' equity will be $36. It will go up, right? So I'm plowing back all my retained earnings over here, equity. Look, the goal in this first stage is to determine how much external financing I need, not debt and equity and all those things. So now I know that after all this, there has to be a balancing because my total assets are 1,100 and my total liabilities and owner's equity is 1,036. So I need the balance, $64. This is my required external financing. Notice here, my assets have increased by $100, the same thing. Out of $100, $36 is financed. $100 increase in assets, $36 financed internally by my retained earnings. So $64 will be financed externally, common sense. So $100 increase in assets minus $36 is my retained earnings, or you can calculate the balancing item or plug as $1,100 minus 1,036, whichever way you can understand better. But I like it straight away. This is my additional need, $100. I'm getting $36 from my operations, my retained earnings. So $64 will be my external financing. So in the first pass that we did, what we did is we just determined the external financing as the balancing item, that this is how, I will need $64 to balance my both sides, assets equal liabilities, my fundamental accounting equation, assets equal liabilities plus equity. So my external financing is a balancing item, and that's all in the first pass. So given the firm's growth forecast and its dividend policy, we calculate how much money, which is obviously $64, these are all Ks, 3 zeros. So $64,000 is needed by the firm, externally, from external funds, not internal. But it does not yet specify how those funds will be raised, which we do in the second stage, in the second part, the second stage pro forma statements. In the second, so we break the step into two parts. So here we will decide, in the second stage, we will decide, the financing mix that best meets the needs for additional or external financing. We choose some combinations of new debt or new equity that supports the acquisition of additional assets. We can go either ways. One way would be, for example, we could issue all this $64,000, we could issue as equity, or we could issue as debt. That could be, depends upon the policy. Or we could also make another policy that, okay, we want to maintain the long-term debt equity ratio the way it is, 400 over 600, 2/3. 400 was debt, 600 was equity. So 2/3 is the debt equity ratio. We want to maintain that by issuing both debt and equity. So a combination of both. Londonderry case. You can do, people can do all kinds of things. You can choose whatever way you want to. It's up to you. Again, I don't say one is right, one is wrong. It depends upon your policy, and everything is good as long as it works. That's the bottom line. So we go to the second stage, pro forma balance sheet for this executive fruit company. And we start with a balance sheet over here. My assets, my net working capital, again, 10% higher. My fixed assets, 10% higher. Total asset is 1,100. So 10% higher. This part we know. How do we finance it? Okay. So in this case, what we did is the $64 that we needed, the company said, we'll just go, debt financing. That's all. So we plowed in $36 of retained earnings to the equity. So it is $636 now. And that is increased by $36 from $600 to $36 by retained earnings. So now we use debt as the balancing item. So in this debt as the balancing item, we are using $64 we need to finance, so 64 it becomes. And notice over here, this balances your debt and equity. So here we are using debt as the balancing item. This is just an example. Again, you can have so many different possibilities over here. Your strategies, your corporate strategies, these are important. Your assumptions are important when you create these pro formas. We'll go over your homework example also with this. But once we have this situation done, then of course we can get your statement of sources and uses of funds. So you are basically raising $100 and $36 you have raised through retained earnings, internal funds, $64 you have raised through debt, new borrowing, increase in debt. Okay. So these are the sources, and sorry. And the uses over here. So uses over here again, 10% increase. 10% of these funds I spent. This was a 10% increase. $20 went for my working capital, increase in my net working capital. and $80 went to increase my fixed assets. This was my use. Very simple. So that's total is $100. So these are sources and uses of funds. We create like that. Now, growth is very important. If a company is growing a lot, then it tends to retain most of its earnings rather than giving out dividends. Faster growing companies uses up all its funds, and the need for external financing is always there. So you will see over here in this case, if the growth rate, sources and uses of funds, yeah. So I'll go to the graph first and I'll show you. See, if we plot the required external funds on the y-axis and the growth rate on the x-axis, you will see that up to a certain level, you don't need outside funds. You will need your internal retained earnings will be sufficient to carry your growth. Beyond a certain level, the maximum internal growth rate, beyond this level, you will start needing more and more external funds. So that's what this graph shows. Where the sloping line crosses the horizontal axis, the external financing need over here is zero. The firm is growing as fast as possible without resorting to new security issues from here till here. Till here, this is called the internal growth rate. Okay, till this part. If the firm's sales growth, the growth rate, it exceeds this internal growth rate, then the firm will need external financing. Whether you go by debt or equity, both are external. So then the need comes for external financing. So in terms of a chart, for this company, if you see, there is no growth needed, you will see that the required external financing is nothing, negative. What you have just now is more than enough. Up till 3.33% growth rate, you can get through internal financing only. No external. But beyond this, you will start needing more and more external financing. And if you go through this, the relationship to determine this is that your required external financing, as we were talking in the pro forma budgets, the increase in assets minus the retained earnings, this is the required external financing. And if we play around with this relationship can be expressed as your required external financing equals your net assets over sales times the increase in sales. This will give you your increase in assets. Your ratio of net assets to sales, say my net assets are 40% or 60% of my sales, times the increase in sales, whatever we are projecting. That is the increase in your assets minus the retained earnings. So in this case, when we are talking in this example of 64,000, we are talking 36,000 was the retained earnings, and my net assets to sales ratio was 50%. So 50% net asset to sales ratio, it was there from the beginning. If you take that times the increase in sales of $200, then that comes to $64 is the external financing need. So this is the relationship. It's a very, 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 very important relationship. Very important relationship. right? See, my revenue went $200 up, huh? Increase in sales, right? $200 up. The same thing we are talking about here in this relationship. Increase in sales was $200, and if you take the net assets to sales ratio, this was also 50%. 1100 divided by 2200, 50%. And that gives you deduct the retained earning, that'll give you the required external financing in this case. That's why 64,000. We already went over this graph. And an important issue over here to know is sustainable growth rate. What is sustainable growth rate? And everybody strives for this. It is a steady growth rate at which a firm can grow without changing leverage. That means without changing your equity ratio, debt to equity ratio, those kinds of things. So steady rate at which you can grow without increasing your leverage at all. And how do you get this sustainable growth rate? Just multiply your plowback ratio. That means the ratio of your retained earnings to your total earnings is a plowback ratio. Or you deduct from one, you deduct the payout ratio. That will be your plowback, payout of dividend ratio. That will be a plowback ratio. Same thing, times your return on equity. That is, it's simply, if you play with these, you'll get the relationship that a sustainable growth rate at which you can grow without changing your leverage is your plowback ratio times your return on equity. And it simply implies that your increase in sustainable growth rate, you can increase your sustainable growth rate by increasing your plowback, the money you retain back in your business, or by increasing your ROE, return on equity, or both. So you can increase your sustainable growth rate either by increasing your retention, that is increasing your plowback ratio, or increasing your return on equity, or increasing both. So when you determine your internal growth rate, you can rewrite this, your internal growth rate, as your retained earnings over asset, which is, retained earnings over assets. How much earnings you are retaining back as a percentage of your total assets. That is your internal growth rate. And that will be, you can rewrite this as your retained earnings over your net income times your net income over equity, which is your return on equity, times this leverage ratio, which is equity over assets. So net income will cancel out, equity will cancel out, retained earnings as a percentage of your assets is your internal growth rate. So this is a very important relationship to know, because higher the growth rate, higher growth rate you can have without raising external capital, with increased plowback or with increased income over equity or equity over asset, or decreased debt to asset ratio is the opposite of this. So if we go explain this further, this is a very, very important concept to understand. Your required external financing, you can rewrite as your new assets, that means what new assets you want to buy as a percentage of sales, times your increase in sales, minus your reinvested earnings or retained earnings. This is your required external financing that we talked about. So keep that in mind. These ratios, will apply them. And the required external financing, remember, increase in assets minus retained earnings is net assets to sales minus increase in sales minus retained earnings. Same thing over here we talked about, So we'll apply these. Let's apply these. Sorry, let's apply these and see how it works. And we got our internal growth rate as retained earnings over assets that we went over, retained earnings over net income times net income over equity times ROE times your equity over assets, which is another leverage ratio that we went over. Let's apply this. First example. So we want to find out what is the maximum internal growth rate of a firm that reports a net income of $500,000 and a dividend payout ratio of 40% and total assets of 10 million. And you will see here, according to this graph that we talked about, the graph here that we talked about, we're trying to find out what is the maximum internal growth rate till here, at this point. So again, you'll see that it is 3%. Here, just use this ratio here. You use this equation here. So your internal growth rate, you calculate as your retained earnings over your assets, which is, retained earnings over your net income. So basically your plowback ratio. This is the same thing as your plowback ratio. Plowback ratio or 1 minus payout ratio is the same thing. Times return on equity, net income over equity times equity over assets. If you cancel out equity and equity, you'll get net income over assets, and that will be times your net income over asset, which is your return on asset. DuPont, we are using DuPont here, DuPont system. So either you can say that your internal growth rate you can get as retained earnings, as a plowback ratio, which is retained earnings over net income, times your ROA, or you can take it as a plowback ratio times your net income over equity, ROE, times your equity over assets, whatever information you have. So here your plowback ratio is given as 1 minus payout ratio, which is payout ratio is 40% of your dividend. Dividend 40% you give, so 60% you retain back. So it is 1 minus 0.4 is 0.6. 60% you return back. This is your plowback ratio. Your return on asset over here, net income over asset is already given. Your net income is 500K and your asset is 10 million. So 500K over 10,000K is 0.05. This is your return on assets. So you just multiply the 2.6 times your return on asset, that is 0.03 or 3% is your maximum internal growth rate. You can do in this company, you can go up to 3% growth rate over here without any external financing. So this is one example. Okay. Another application of the ratio the equation that we learned here, how do you determine the required external financing? That means your, whatever is new assets to sales ratio times your increase in sales minus your reinvested earnings. This new assets to sales ratio times my increase in sales will tell you how much increase in my asset I have. So new assets to sales ratio times increase in sales minus reinvested earnings. So here is the application. Here we'll see, what is the required external financing if first stage pro forma statements indicate, and you know now what is the first stage pro forma, it indicates 1 million in net income, 300K in dividends. 1 million net income, 300K dividends. So reinvested earnings is how much? 700K is your reinvested earnings, and 900K increase in my total assets. So my increase in total assets is 900K, right? And you don't even need to calculate. You can know this just by looking at it. Your total 1 million is net income, right? You plow back after paying off 300K dividend, you plow back 700K. This is your reinvested earnings, 700K, this part here, reinvested earnings, 700K. Okay. And then this part, this whole new part, new asset over sales times increase in sales, is the increase in your total asset. This part is the increase in your total assets. So over here it's 900K is the increase in the total assets minus, how do you finance it? Well, 700 you finance through your internal funds. So how much external fund do you need? 200. This is what it is. So that's how we explain it here. So here our retained earnings or reinvested earnings is 1 million minus 300, or 100K minus 300K, 700K. My increase in assets is 900K. So my required external financing equals, we plug in this whole thing. If you want to plug in. So it is new assets to sales times increase in sales minus my reinvested earnings. So increase in assets is 900K over here, and my reinvested earnings 700K. That's 200K is my need for required external financing. Actually, we have done this so many times in the pro formas that we are creating. The same thing we do. But remember, these equations, they are very handy, very useful. Remember, though, that the assumptions of percentage of sale models, in real world, the net working capital, like our inventory, cash balances, all these kinds of things, they do not always increase directly in proportion to sales. So here, line B over it shows that in reality, you got to start with some working capital and not zero working capital, net working capital. And then as your sales increases, it may not always increase directly in proportion, say 10%. No, it might go less, So this graph is actually at 0.075%, and this one is at 10%, A is at 10%. And this B is 7%. In reality, it doesn't always happen because of so many, economies of scale and all those kinds of things they come in. Also, when you require external financing for investment, okay? When you invest in capital assets, these are major investments you make. It's not that, okay, I want to increase a little bit, my sale increases by $100, so okay, so much more investment I make. Increases by $200, so much more investment I make. Because if you're running a factory, for example, a capital investment probably will carry you for some time without making any more capital investment. Typically, if you operate below full capacity, say at point A over here of sales, okay, point A here. So if you are operating below full capacity, then you can keep working and keep increasing your sales, until you can keep expanding your sales until, say, a point B, where you can't go anymore without any additional investment. And then you will make that investment in your plant and equipment and assets big time. And then suddenly your fixed assets will go up till here. Then again, it will carry you to a certain level. Beyond this, again, it will go the same way up to a certain point. So it rises in steps. This is kind of a, your capital investment rises in steps. It doesn't go directly always in proportion to your sales growth. So keep that in mind. Remember over here that sometimes people tend to ignore realities such as depreciation, taxes, all these things. Remember that when you do your percentage of sales model, don't increase your fixed costs. Their fixed costs remain fixed. They don't increase with all your increase in sales. So keep that in mind. We did that in our, in some examples. Then most models, they generate accounting numbers, not financial cash flows. What is the difference between the two? Depreciation is a classic example. Net income plus depreciation. When you want to go into cash flows, basic accounting says you got to add back depreciation and non-cash expenses, depreciation, amortization, all those things you have to add back. So, but most models, they don't take cash flows into account, not financial cash flows, just the accounting numbers, return, net income and all. So that you should generate in your pro forma cash flows also simultaneously support this. Finally, remember that adjustments must be made to consider many other factors, could be other factors also, not just these that we talked about, but other factors you need to make adjustments for them when you create your own pro forma statements. So this was just in a nutshell what we talked about, and I will stop here for a time being. And I hope it stopped recording. Didn't say it stopped recording or recording.
The icon still says recording.